Good evening, everyone, and welcome to UCLA Anderson, at least virtually. My name is Lori Santikin. I'm the faculty director of the UCLA Fink Center for Finance and a professor of finance and strategy here at Anderson. On behalf of the Fink Center, the UCLA Anderson Masters in Financial Engineering, and the entire UCLA Anderson family, I'm thrilled to welcome you to this very special event. The UCLA Fink Center for Finance aims to cultivate and translate innovation at the frontiers of finance. We do this by supporting and disseminating cutting-edge research, connecting academia with industry and policy, and training leaders along their professional journey. Today, we are privileged to partner with Women Investing in Security and Education to bring to our community insights from some of the most impressive individuals in finance who just coincidentally happen to be women. None of this would be possible without the dedication and commitment of women investing in security and education. And so I'd like to introduce Angela Daly, CEO of WISE, to introduce our program.
Casey, I think somebody needs to start my video. Whoops. There we go. Thanks, Lori. Thanks for the kind words and for being such a great partner to WISE. Hello, everyone, and welcome. I'm Angela Daly, WISE CEO. We are thrilled and privileged to be partnering today with both UCLA and UC Berkeley, such prestigious universities. In 1997, a group of women, a very powerful group of women, met in Orange County to put on an investment conference for women. To their absolute amazement, more than 500 signed up for this event, and they knew they were onto something. Fast forward 25 years, yes, it's our 25-year anniversary, and WISE remains true to its mission of financial empowerment for females of all ages and all socioeconomic backgrounds. We do this because we believe that if you manage your money better, you're going to have more opportunities and more options in life. WISE works through community organizations such as Girl Scouts, Girls Inc., universities, and women's shelters. And every year, we reach thousands with this empowerment message. Tonight's event is part of our groundbreaking Tearing Down the Pink Wall series, where we gather the best and the brightest in finance to let us reach for the stars and educate us. We all under the mantra of she can be what she can see. Tonight, we have three financial world influencers. They're Karen Choi, the Capital Group, Sarah Ketterer, Causeway Capital, and Robin Potts, Canyon Partners. All these women share our passion for financial empowerment, and they are part of a very elite group. According to Morningstar, only 11% of portfolio managers are females. And this number, sadly, has not moved for a decade. And in fact, some surveys show it's going the wrong way. We have a two-part program. You're going to hear market insights and then the career journeys that led them to the pinnacles of the financial community. We hope that we inspire all of you to reach for the stars and some of you to join us in financial services. Now, it is my great pleasure to introduce my close friend, our moderator, Consuelo Mack. Consuelo has been a very important part of this series since its inception, and really what makes it unique, one of the things that makes it unique. She is one of the most influential financial journalists in this country. She was an anchor on CNBC. Now she hosts her own show, WEALTHTRACK, on PBS, which WISE is very proud to be one of the sponsors of. Consuelo is a fierce advocate for diversity in the workplace, especially women in finance. So please join me in welcoming Consuelo and our distinguished panel. And one bit of housekeeping, we're going to take questions at the end, put them in the Q&A box, not the chat box, and then Lori is going to field those questions. So Consuelo, showtime.
Thanks, Angela. And I can't wait for those questions as well. And I want to thank you, Angela, and our fabulous hosts and our partners who are sponsoring this Tearing Down the Pink Wall series. And this event in particular, I'm honored to be here with these influential women in finance, and I can't wait to hear their views from the top. So there is a lot going on in the world right now in geopolitics, the economy, and also in the markets. And they have much to share with us. But first of all, I just want to reiterate something something that Angela just said, which is that we are all here with a common mission, and that is financial literacy, which is what WISE does in preparing girls and women for leadership roles in the dynamic financial services field. And it's what our three panelists represent. So this event is not just for women. However, for those of you out there who are not women, I want to make sure that you know that this is an inclusive session here. Financial literacy is for everyone. It is really the key to financial security, which is a critical part of a successful personal and professional life. And I might have to put a plug in as well for the financial services industry, because I was part of it once. I've been covering it for 30 years. It is exciting, it's dynamic, it's competitive, and it can be incredibly rewarding, both personally and professionally. It's basically now open to all comers. So if you've got talent and you've got drive and you've got ambition and you've got discipline and the ability to deliver results, which is basically what the financial services industry cares about the most, there are huge opportunities in this field. And we'll be talking to three terrific representatives of it. So let's get started and meet our three panelists. And you've seen their bios. So I'm going to make my introduction to them brief. But first up, Karen Choi. She is a fixed income portfolio manager at the Capital Group. And for those of you who don't know the Capital Group, it is one of the most respected firms in the mutual fund and money management business. It's known for its disciplined team approach and also its integrity and for putting clients first. And Karen manages investment grade corporate bond portfolios. Those are the highest quality corporate bonds. And also she manages several portfolios at Capital Group under the American Funds name. And prior to becoming a portfolio manager, she was an analyst specializing in the U.S. electric sector for over 2 decades, i.e. utilities. She is a chartered financial analyst and holds a BA in international relations from Wellesley College. And you'll see later when we get to our career section why that's important for each of them. Sarah Ketterer is CEO of Causeway Capital, which she co-founded in 2001. Highly respected global value firm, portfolio manager for its fundamental and absolute return strategies. Sarah is the winner of Morningstar's International Stock Fund Manager of the Year Award, really a fantastic honor. In 2017, she and her team are for her flagship Causeway International Value Fund, and she was nominated for the same award, which is extremely rare, in 2013. And her Causeway International Value and Causeway Global Value Funds carry Morningstar's highest rating, their gold analyst ratings, which is, again, the highest that firm gives. And Sarah has a BA in economics and political science, a double major from Stanford, and also holds an MBA degree from the Tuck School of Business at Dartmouth. Finally, Robin Potts, co-head of real estate investments, director of acquisitions at Canyon Partners Real Estate. And that's the real estate direct investing arm of Canyon Partners, which I had never heard of until I started looking into Robin and it. It's a global alternative asset manager with about $30 billion in assets under management. It's an alternative asset manager. She originates the originations and the acquisitions of all real estate transactions at Canyon, over $14 billion worth of deals in 15 years there in debt and equity, commercial real estate. She oversees all asset classes, of which there are many. And just to name most of them: multifamily, condos, office, retail, hospitality, industrial, senior housing, student housing, for those of you who are interested in that, and self-storage. She has been named one of the 25 most powerful people in commercial real estate in LA by an industry publication. She holds a BA in economics from Harvard. So as Angela mentioned, this is a 2-part conversation. First, the investment climate for about a half an hour, and then we're going to talk about careers. How did they get to where they are? And we're going to ask them for some advice for the rest of us. And then Laurie Santikian will field questions from all of you. So as Angela suggested, please submit them to the Q&A box, because we'd like to take as many as we can after we cover our 2-part segments. So let me just quickly say the macro picture, the backdrop that all of our panelists are investing in is just incredible right now. I mean, it is, the biggest changes in a couple of generations. We've got the highest inflation rate in 40 years. First time in 40 years that interest rates will actually be rising. The great bull market is over. We had the worst first quarter in the first quarter of this year in the bond market in its history, and one of the worst stock market performances to start a year ever. So it ranks in one of the top 10. We also have a huge reversal in a trend that we've been used to and expecting and gotten comfortable with in the last 30 years, which is globalization. We are now reversing that trend, going to deglobalization, where there are going to be different regional pacts. People are basically working unilaterally. There is, instead of offshoring jobs, we are onshoring. This is a major, major shift. And we, as you all know, in the tragic war that's happening in Ukraine, we are in a scenario of a possible Cold War II. I'm not going to say World War, but this is the worst outbreak of war in Europe since World War II. And the markets reflect all of these events on a daily basis. So our panelists have to consider it all. So my first question to each, and I talked about a dynamic field, the financial services industry. I mean, this is just an example. This is an incredible example of how exciting it can be and how challenging it can be. So Sarah, I'm going to start with you because you represent the equity piece of our panels. And in this changing and challenging investment environment, what are you paying the most attention to? What are the two biggest themes that you and Causeway are focusing on?
Well, thanks for the question, Consuelo, and thank you, Angela, for inviting me. What's always important, regardless of the economic environment or geopolitical environment, is valuation. So we focus on valuation because that is the only solid ground you walk on. Everything else is moving. But if you can determine precisely what you're willing to pay based on very conservative assumptions, then you have an investment thesis and now you can go to work. Otherwise, as you noted, there's so many different distracting and conflicting events occurring all at once. You couldn't even get out of bed if you didn't have some sort of discipline on how to deal with that. And that's through valuation.
And when you're talking about valuations, you're looking specifically at individual securities, individual stocks. You're looking at stocks globally, both, and you're looking at, you are value managers. So you're looking at valuations as a value manager. I read a recent interview that you just did with Morningstar where you said for a value manager, you're screaming with joy as the markets collapse around us. So talk to us about the valuations that you all are seeing at Causeway. I mean, put them into perspective.
Well, I just think about, as much as I don't enjoy growing old, there are certain benefits. I started my career out of college and saw the 1987 market crash that happened in the US, and it was terrifying. And I didn't know what was going on. And 10 years later in Asia, there was an Asia financial crisis and stocks collapsed. They sold off. Now, this is what I mean by valuation. If you think about what a company has, it has assets and liabilities and has net worth. And often, as you think about net worth in terms of that's really the book value, and would you pay some multiple of book? Would you pay even book value for the business? What kind of return on its equity does it earn? Those are some of the calculations we do. We're always measuring how much cash does the business generate, and how much cash will it generate? And if you discount that cash to present using a discount rate, and that's really important because now the discount rate's rising, then you determine what the business should be worth today. And in that 97 Asia meltdown, stocks traded for the level of cash they had on their balance sheet then. Literally, their market capitalization so dissolved, there was nothing left but just and it was a buyer's dream. So that's why we get exuberant when we see irrational selling, because investors can, and they did this into March of 2000, they sold everything. That was the TMT, telecommunications, media, and technology bubble bursting. And then in 2020, March of 2020, we had a very brief sell-off until rescued by central banks and governments. And that was due to COVID. It just a panic. It really happened in more like February and then March of 2020. collapsing markets. And now, interestingly, in anticipation of what is really an economic cycle, we're supposed to have them, even though we tried to avoid them. We're seeing rising interest rates. They will continue to rise in most regions around the world, with the interesting exception of China. And monetary liquidity, the amount of liquidity that's put into the banking system that's ultimately lent and therefore creates economic stimulus, that's being reined in by central banks. And all of that makes for a very sobering investment environment for speculative stocks, those where valuations were irrationally high. And now they're coming tumbling down, which is something that we appreciate, because that's what we do for a living. We analyze, and as I talked about before, that solid ground is the valuation, and it has to be made up of earnings that you can actually measure, not some idea there might be someday earnings from a business. That's more like speculating than it is investing.
So this period, and then I'm going to move on to the other panelists, but this period is reminiscent of which of the market declines that you just mentioned? I mean, are the valuations that you're seeing now as good from a value manager's perspective, as attractive as they were, in, 1987, in the, global financial crisis, or in March of 2020?
Well,
where are we?
We're in a very unique environment. Every meltdown has some resemblance to prior, but they're all different. And this one is inspired by the fact that I think that we'd call the term over earning. Stocks literally delivered, especially in the US market, much more than they should have. Earnings went up, yes, but valuation multiples went up more.
Right. The price earnings multiples just expanded like crazy.
They did.
Right.
They did. And that has a lot to do with what central banks have been doing, and the Fed in particular. The Fed created $4 trillion of additional money supply in the pandemic period. And this created just so much money chasing a finite amount of assets, or what we call asset price inflation. So assets prices went up, namely stocks, homes, old master paintings, fine bottles of wine. I don't care what it is, it all went up. And now, of course, we have a central bank very nervous about wage inflation, a real wage price spiral. So the stocks that are interesting today they're already pricing in a full-on recession. It's already in the price. So that's what we're looking for, is where the market has already discounted the downturn, and yet the tightening has just started.
Karen, let's bring you in, because we think in a lot of the financial press covers the stock market more than they do the bond market. But what is going on in your market, Karen, is phenomenal. And that is, Paul Volcker in the late 1970s, early 1980s, basically, murdered the economy in order to bring inflation down, which was in the, running at 20% a year. So right now, we've had a 40-year bull market in bonds. It looks like that is finally reversing. Jerome Powell, the current Fed chair, has said, that he's going to do what it takes to bring inflation down. It's running at 8% levels in the consumer price index. The Fed target is 2%. That's going to be a lot of tightening. So this is a dramatic moment for you as well as a bond manager at Capital Group. So what are you all focused on at Capital Group in the fixed income world?
So just to point out, so Capital Group, we are a private firm, and so we don't give any specific investment recommendations, and each analyst and portfolio manager actually has different views. There is no house view. So everything I say today is my personal view, and it could change tomorrow, just to let everyone know. But I would say, as an investor, it's our job to really predict the future. And my crystal ball is very, very fuzzy right now. There's a lot of snowflakes in there. But I would say one of the things that I was very convinced on, that rates would definitely go higher this year, and inflation is for real, and it's going to stay around for a longer time than people expect.
And why do you say that, Karen? What's convincing you that inflation is
it's actually some really just even simple numbers just look at where unemployment is and job openings. You have a disconnect of 6 to 7 million unemployed, but 11 million jobs out there. So that wage inflation is real, and it's going to take some time for it to change, right? The supply issues are real, and they're not getting any better. There were quite a few calls that happened over the last few days, and you're hearing the supply issues and supply constraints may not really improve dramatically for everyone anytime soon. So those will still be lingering for some time. So I am in the camp that inflation is real and stagflation is a real possibility here. And I have never really invested in this type of environment in my entire life.
Very few people have, incidentally. I mean, you would have had to have been, a full-blown adult portfolio manager in 1980. So that was, more than 40 years ago.
So overall, I have a fairly cautious outlook, and I came into the year with a high level of cash and a fairly cautious outlook. And I was short duration. I did think I was genius because I covered my duration short back in March. But here we are.
Duration, and explain what duration is.
Duration is basically the length of the maturities of your portfolio. And in terms of where the 5 and 10 year were at the time, they were under 2%. And we started off the year closer to 1%. Right. And we're closer to 3% today.
Right. 5 and 10 year treasuries.
Yeah, treasuries. And I thought I was genius because I was short duration from 1% to 2%. And I covered that. But no, look at where we are today. So in terms of where interest rates will end up at the end of the year, I'm not the expert there. I'm not the Fed watcher, but I do think there's chances that it could be around the same or higher. So that's kind of what I'm thinking. In terms of stagflation, though, could be real. And I do think, my sense is that we go into a recession in the next 12 to 18 months.
And stagflation being that inflation's pretty high and economic growth is pretty slow.
Will slow down.
Right, will slow down.
Yeah. And I think Europe will lead that, and then we will follow.
So, and you say that because Europe right now, their economies, I mean, they've got a war on the continent. So their economies are slowing faster and more dramatically than our economy is.
Yes.
Right?
And energy prices. I mean, I'm hearing about shortages everywhere globally. And even in the US, I keep hearing all the different, and this is because I'm still close to the utility sector, but there are going to be some shortages over the summer. So, there could be some really high energy prices. And I think the latest numbers I saw was electricity prices were up for consumers 11%. Those numbers could be a lot higher over the summer. So that's going to really eat into the consumer's pocket. So I don't think that changes anytime soon. Mm-hmm. And that dynamic is going to play out over the rest of the year. So although I would say I'm not telling a very rosy picture, but I would say as an investor, I would say it's very similar to what Sarah said. It's exciting. There are opportunities out there, and we're just continuing to watch all the different things that are going on in the market. And maybe there's some companies that I really, really like, and the valuations are starting to look a little attractive, and we're reinvesting at higher rates too. I'm buying some company bonds, very short duration, like 3 to 5 year bonds, yielding 5%. I couldn't get anywhere near that 2 years ago or even a year ago. So there are some interesting opportunities that are reappearing and are appearing now. So it's actually a very exciting time to be investing. It does you feel sick to your stomach sometimes when you're making those investments, but at the same time, there are some exciting things going on.
So everyone is watching the Federal Reserve, and one of the things that has been a criticism of this Federal Reserve is that it really just didn't have the nerve to rein in inflation. That it was not going to be as firm as Paul Volcker was in the early 1980s. And Jerome Powell has come out and said that he would do what it takes. But it's one thing to say it. It's another thing to do it. We've only had 2 interest rate increases so far this year. So how closely are you watching what the Fed is doing? And if the Fed turns out not to be as strong as it's saying it's going to be in fighting inflation, what does that do?
I think they'll do 50 and 50, but I don't think they
50
do
basis
75.
points, sort of half
I
a
don't think,
percentage point.
yes, I don't think they do 75 basis points or 100 basis points. I think
Right.
that would really spook the market. And I think they're going to be slower and they're going to be steady. But unless something dramatically changes, I don't see them going off course too much.
Okay. Robin, real estate. Everybody cares about real estate. You deal in the commercial real estate field. I know there's this new series on TV about WeWorks, and so that I've heard is terrific, an amazing story. But what are you talking about at Canyon?
So, the real estate market is a different space than Sarah and Karen just described, in that, it's private market transactions. And within the private markets, the story is going to take longer to actually play out from a valuation perspective. The public markets really reflect kind of immediate reaction to all of the news. And in the private real estate markets, owners of assets can wait and see and be more patient on transacting unless there's a forced event which is causing them to transact. So there's a lot of discussion right now about where valuations for commercial real estate are headed, because that price discovery needs to play out. It's not a perfectly transparent process. And, real estate, generally speaking, is on the one hand, benefits tremendously from an inflationary environment, because for many asset classes within real estate, rents can reset frequently, like, for example, in apartment projects where you can be resetting rents annually for tenants. So on the one hand, that's a positive in this environment for real estate. But on the other hand, real estate is generally a leveraged asset. And so the rising rate environment and the relationship between your borrowing costs and cap rates is something that at the moment, things are a little bit upside down, and you have a negative leverage situation with respect to where cap rates are relative to rates. So
and cap rates are what?
So cap rates are the rate that you apply to an income stream to value real estate. So it's the inverse of a equity multiple in the public markets, so right now, for example, kind of prior to the volatility, you might see an apartment building trade at a 3.5 cap rate because you could buy an asset utilizing debt in the low 3s from an interest rate perspective. And now that same debt is in the mid 4s, but the cap rates haven't moved up commensurately. And so there is a negative leverage concept in the market currently that needs time to play out. And then the other thing that we're paying a lot of attention to, because we invest a lot within the development space, so we're highly involved in terms of asset creation and the construction of new assets. Within that space, the inflation environment is really affecting the construction costs, and overall, the supply chain issues are also driving up construction costs. So we spend a lot of time evaluating the relationship between the rent growth, which is very strong, relative to how the costs have changed, and whether that equation still makes sense to proceed forward on a new opportunity.
And I read one of the reports that Canyon had put out to clients about conditions in the marketplace. And, you just mentioned, so multifamily buildings are still very attractive, I guess, as an investment, but things like office space is not necessarily. And I was wondering, how you all look at the Great Resignation that we've heard about, the fact that so many millennials are really very reluctant to go back to the office, and they're quite outspoken about that. And it's a tight labor market, so they have some clout. So as far as how is that affecting the finances of the commercial real estate and the office space, for instance?
Sure. So as you pointed out, multifamily fundamentals have been almost universally strong across the board and across different profiles of multifamily. The office sector has been quite disparate in terms of outcomes for specific buildings. And so within the post-COVID environment, with flexible work and a hybrid work environment, and the need for employers to essentially be able to provide office space that's attractive and has amenities and the ability to kind of induce people to come back and return and be together as a team. There has been kind of a major distinction between high quality office projects. And so we've seen tenants really demonstrate a flight to quality preference versus your more commodity type office space. And so I think in general, and it's going to take a fair amount of time to play out, but many cities across the US have outdated an older office stock, and that ultimately needs to be kind of repurposed or transitioned into a new use over time. So we're actually seeing a number of real estate owners and operators propose conversions of office space to other uses, while your newly built high quality office in strong locations and growing markets across the country, we think will really outperform.
I know you don't do retail housing per se, single family homes, but do you have any thoughts? I'm thinking of our audience. They might be renting, or they might, they'd like to buy a home at some point. What's your sense of the housing market?
So the housing market has been kind of incredibly constrained from a supply perspective. And as a result, you've seen within the single family market just an incredible price appreciation, which has made it very challenging for first-time home buyers. And there's been just a tremendous amount of competition. And now you've compounded that price escalation with rising interest rates, and seeing mortgages now at the 5% level for the first time in over a decade. And so that combination really, in my view, kind of tips the equation very much in favor of renting. So that rent versus own equation, and what is your monthly payment, even with the significant rent growth increases that you've seen across the US within the apartment space, we think that it ultimately just continues to strengthen the apartment fundamentals, given the single family home market, with the combination of the price increases, the constrained supply, and the increase in the mortgage rates, kind of all combining together to make that less affordable.
So I'm going to switch now to strategies. And Sarah, let me start with you. You mentioned, and I mentioned, the fact that from a value investor's perspective, the more stocks decline, markets decline, the better it is from a valuation perspective. So what are you doing? Where are you seeing the biggest opportunities?
It's where the market has been most savage, in the realm of companies that actually have earnings and cash flow. As I mentioned earlier, the stocks that have fallen the hardest this year have been those that have none. And to put this back in sort of fixed income parlance to fit on an equity model, those would be very long duration stocks. In other words, there's no cash today. It's all promised sometime so far out in the future that you're going to be waiting a long time to get it. And that makes them especially rate sensitive. So as rates are rising and are expected to rise quite a bit more, those are the stocks that have fallen the most, or think of it as multiple shrinkage. So that's not where we're looking, but where we are looking are areas like banks, for example. They tend, and we've seen this in prior cycles, they tend to sell off. In other words, their multiples fall and they tend to underperform as you are approaching recession. And we're expecting, if it's not a technical recession, certainly a significant slowing of the U.S. economy. And I agree. I think Europe's going into recession, has all kinds of problems. But there's no reason not to go shopping, even though it looks like there's going to be an economic slowdown, because markets are very anticipatory. Equity markets price in events long before they occur. So they price in the downturn way before it even happens. And the most sensitive stocks that do that are typically cyclical. And amongst those, the biggest culprits are the banks, because they're just levered. You think of them, they've got a little tiny amount of assets, and then they do quite a lot. Well, tiny amount of equity on a big pool of assets, and they do quite a lot with it. So they're obviously in much better shape than they were in the 2008 global financial crisis. I mean, that's a pretty low bar. but they're in so many different markets. As markets are beginning to anticipate a slowdown, a significant slowdown, the bank stocks have tumbled. And interestingly, and that's why I bring them up, to levels that we saw during the global financial crisis, to those sorts of valuation levels. Think about it on a price, we call price to tangible book value. So you take remember I talked about assets less liabilities as net worth or book value. If you strip out anything that's intangible, the squishy stuff, and you end up with real book value, that is real value for shareholders. When those price to tangible book value multiples get to something like 0.25, 0.3, 0.4, those are crisis levels. Again, very reminiscent in particular of European banks that we saw in the global financial crisis. But what's different now, and this is why we get excited, because that's just a sort of blanket sell-off. They were all decapitated at once. That's what we call indiscriminate selling. But these banks are in demonstrably better shape than they were back then. They have raised lots of capital. They have huge, what we call capital cushions. So they have equity to assets. The equity portion is much bigger now, and it's far in excess of what their bank regulators in their regions demand. And they're already being allowed, despite the fact that we are approaching an economic slowing period and rates are rising, to return capital to shareholders. So their own regulators are signaling that they're in sufficiently good shape. They can carve out some of the money that they're earning and send it back to our clients, their shareholders, and in terms of dividends. And I mean, there are a couple of banks that we've seen in Europe that are doing buybacks over the next 3 years. Will
stock buybacks.
Yeah, stock buybacks. They'll buy back some of their shares outstanding. And when you buy back stock at such a low price to book value, it's very accretive. And all of a sudden, think about it as price to book per share. You've got book value per share, so many fewer shares, and now you have this bigger. You have this, the ratio looks much more attractive. Let's put it that way. So from a price to book perspective, we're getting a tremendous bargain. And, there are many different industries, but what they have in common now is they're generally cyclical, because once February 24th rolled along and Russia invaded Ukraine and this incredible human tragedy unfolded, investors, they do what's called shoot first and ask questions later. A lot of stocks were just sold, and nobody has really they don't understand yet where earnings are headed. But if you look out beyond the next 12 months to the next 24, the 36 months, it's much easier to make a projection, because we can look through the downturn to the recovery and start to price that in. If you're someone who expects cataclysm, you shouldn't own stocks at all. Just put your money under the pillow, and or maybe it's crypto you should own. I have no idea.
So, Karen, what about putting your money into bonds? When I'm listening to Sarah, it's, you can see as a value manager that she does have nerves of steel. She's been through these cycles before. What's your strategy in the bond market? You mentioned a little bit of it, but are there huge opportunities being created, or do you see any bottom in sight? Is the great bond bull market of the last 40 years, is it definitively over? Just what's your strategy?
I think it's interesting, because I do think people believe that if you invest in the bond market today, that you're going to just continue to bleed money. But if you look back at history, some of our own funds, the returns are actually very similar in rising rate environments and declining rate environments, because we get to reinvest at the higher rates. So it's really, for me, it's about making sure that I'm reinvesting, and I'm reinvesting in companies that I think are just going to do well in general. And so it's really being disciplined and not really being scared and just selling everything or going all into cash. It's really being disciplined about continuing to reinvest, because I think at the end of the day, yes, depending on how dramatic the treasury rate moves are going to be, you could still have an okay year in corporate bonds. Might not be this year, but over the long term, your returns could be quite okay over the long term. Because think about it, like I said, 10-year at 3%, your overall yields, you're getting 4 or 5% on a investment grade corporate bond, whereas you were getting almost nothing 2 years ago, right? So that's a pretty big difference. And you're continuing to invest when rates are going higher. So I'm not as negative, but at the same time, you have to continue to reinvest. And then I think spreads overall is another part of the picture, and investment grade products or spread products. So
the spreads being the difference between bonds of different maturities, right?
And also it's the spread to the treasury. So when we started the year, I would say maybe the corporate index, which included the treasury and the spread, investment grade corporate spread, you were probably yielding like 2%. And so today you're probably 4 to 5%, but that's including the treasury part of it, which is closer to 3%. And then the corporate spread today was like 150-ish, so 4.5. So you're actually getting a little bit more spread on the investment grade side also. Mm-hmm. And over time, if you look at really long periods of time, it really doesn't go much wider than 200 to 300. So even
basis points, so 2 to 3% full percentage points.
Yes. Mm-hmm. So you'll see that collapse over time as the economy start to change too. So like Sarah said, basically the markets will react much quicker than what the numbers or the economic numbers will fall out, when the economic numbers will fall out. I think in terms of even equity markets generally predict the end of a recession 4 months prior, right? And so you'll see that change happening over time. And so overall, I think just continuing to invest is the right strategy.
Robin, strategy as far as yours financing the kinds of deals, what are the strategies that you are doing at Canyon?
So we're nimble in that we can invest up and down the capital stack. We have both debt strategies and equity strategies. I think one of the more interesting areas within real estate right now is within the credit space. So as a direct lender, we can originate senior debt or subordinate debt on real estate opportunities ranging from, existing assets with a bridge and lease up or transitional play to construction financing. And in markets like this where banks are pulling back and, taking a wait and see approach or just a more risk off approach generally, other types of lenders have pulled back pretty significantly as well across CMBS and the CLO markets for real estate. You're seeing a gap that alternative direct lenders can fill at much higher absolute yields than you were looking at the beginning of the year, with very strong borrowers with substantial subordinate cash equity investment in high quality real estate. And so it's a pretty exciting kind of adjustment to the market for a direct lender within commercial real estate, in my view.
So I'm going to ask you, we're going to switch over to the career segment in 1 minute. But my last question in the investment segment is, so if you had one piece of advice for investors in this volatile, highly charged market environment, what would it be? Robin, do you want to lead us off in answering that?
Sure. So I think, and Sarah mentioned this a bit earlier, that everything just got more either kind of cheaper if from an equity perspective or from a debt perspective, more yieldy than it was just a short while ago. So, so long as you have the capacity to be making new investments right now, this is a much more opportunistic environment to be finding interesting things to do. So I think it's pretty exciting kind of across the board.
Sarah, what is your one piece of advice to investors?
Well, I have the same piece of advice regardless of the market environment, and that's be diversified. We have a group of quantitative specialists on our team who have what's called this sounds very complex. It kind of is a multi-factor risk model, and it allows us to understand at least the market portion of risk, because there are risks where there's market sensitivity known as beta, and there's volatility risk, and there's size risk, and value and growth risk. But being able to parse that out and know just how you're positioned. And the reason why I keep emphasizing this is because you just don't know what's going to hit you. Like we've had so many crises and exogenous events pop up. And we went from the pandemic and then to this invasion of Ukraine and exacerbation of inflation. So even though I talked earlier about cyclicals, we have economically defensive stocks in the portfolio too. The key is to be defensive and cyclical, and do so with the better companies, because we really don't know which way this is headed. We do expect inflation, but just how severe the downdraft will be and what other event might occur, who knows?
Karen, same question to you. Your one piece of advice to investors.
Don't panic and look to invest for the longer term, because I think time, like if you have time and you can invest 2 to 5 years out, I think you end up making the right decision. If you're trying to panic and you're looking at the markets every day and you try to, I mean, I wouldn't react to the everyday movements in the markets. I would just not panic, take a deep breath, look at the valuations and invest for the long term, because in the end, I think that's how you succeed.
I'm going to, thanks. And we're going to move on to the career part now, but I want to encourage our audience to submit their questions. And I'm looking, just put your question in the Q&A box. So we would love to take some of your questions after this next segment. So let's move to the career segment of this. And Sarah, I'm going to start with you. This is all about, how you got to where you are today. We want some personal anecdotes, and also we want to know your advice for us as well. So I'm going to start out with how important your education was to your career path. And as I mentioned in my introduction to you, you had a BA, I think it's in economics and political science, and then you got an MBA. So how important were those degrees, if at all, to your career path?
Those degrees in particular, the combination of those, extremely important to where I am today. But I have to give you a big caveat. We've hired many talented research analysts in our firm. Again, we manage equities only, and they're not particularly interested in getting a graduate degree, and they're doing just fine. So it really depends on the individual. I came out of college very theoretical, as one often does, and launched into the world of corporate finance, taking companies public and doing some quick valuation work, but a lot of drudge stuff, like preparing a prospectus, the document that allows investors to know what it is they're buying if they ever even read it, and lots of tire kicking, really understanding the companies and making sure that the accountants were satisfied. Anyway, I did that for a couple of years, and I really still hadn't learned anything particularly useful. I mean, I could have gone on to be an investment banker. No, I don't think it's a particularly salutary career for women or anyone, frankly. I know more broken homes out of that industry than any other. But after I finished dissing that, I don't think there's anybody on the call, ideally, who's... No,
and that's where I'm just saying that's a warning to our audience out there. That investment banking used to be the place that everybody and every MBA wanted to go. And you're saying, forget about it.
Yes, well, I went there too. Even after grad school, I went there. But I just found the hours ridiculous, and the key is you've got to keep learning. When you're in your 20s, you've got to keep learning all the time. And if you've stagnated and there's no opportunity to be learning more, leave. This is a job environment. I think co-panelists have talked about. There's employers we are hungry for people. So you can go anywhere you like if until we are in recession. So I would do it now, but that's a great opportunity to keep learning. So I thought education was really important. It wasn't just what I learned, it was the people I met, the networking, the connections, the classmates ultimately went on to run I have a
both undergrad and MBA in business school? Okay, both. Okay.
But particularly grad school. And I needed to talk, running an asset management firm. We're not very big, but compared to the Leviathans out there, like a Capital Group, but we share some of the same problems. And I have had former classmates who've been the CEOs for periods of time of other significant asset managers, some of them publicly listed. And they've been invaluable sources of advice for me. And I've tried to reciprocate. So yeah, I think there's something to be said. It's a big opportunity cost to go to grad school. You're missing out on earnings, and it's obviously quite expensive, but I thought it was well worth it.
All right. Well, our other two panelists chose not to go to grad school. So, Karen, let me ask, BA in International Relations at Wellesley, at one of the Seven Sisters. It's an all-women's school. How important was your education in your career choice and trajectory?
Not as important, but I think it really is. I think it's different for every individual person. Being a Korean American, the only jobs that my parents ever thought they would want me in is the legal field, or being, it's basically
a doctor or a lawyer.
Doctor or lawyer. Exactly.
Right.
That's it.
Okay.
And at one point I aspired to be in the communications business because I didn't really see many Asians, and there was Connie Chung back then. And so there were not that many Asian female and, a lot of these professions at that time. So that was kind of my third choice. So for me, it was really taking the opportunities that presented themselves over the years. And so the advice that I would give young women is that, I think Sarah hit one on the head, was relationships. Relationships actually matter. And one of the things that I see all the time is that women pull back and they don't build the relationships over time, because you just don't know how someone can help you over the long run. And I would say my husband is excellent at that. And so I learned a lot from my husband and what he does. So it's really, remember, build relationships over your career, because you just never know where you'll end up and who can help you, or who you can actually help also. So it's that part of it. And so, for me, the MBA didn't matter either, because I already had my MRS. So it wasn't like I needed to go get my MBA. So It wasn't as important. But I did, for investment management, I think if you don't have your MBA, it is very much encouraged for people to get their CFA. So I do have my CFA.
Chartered Financial Analyst, right?
Yes. And so I would say, if you do decide not to go to get your MBA, I would get your CFA, because I think that is very helpful. And a lot of investment management firms will actually, see them equivalent to each other, and getting your CFA is a lot cheaper.
Right. And it's a lot of work, I might add.
It's a lot of work,
and it's
but
really hard to get it. But
it's a much less, much less costly.
Right.
Option.
Right. So, Robin, BA in economics, not getting your MBA, what was, and how important was your major and your education, your undergraduate education, and the decision not to get an MBA to your career?
So my undergraduate major was in economics, and overall, my undergraduate education was incredibly important in terms of the relationships that I formed there, and also being a school that had great recruiting access. And so I was able to go, from undergrad into investment banking directly because of the recruiting resources on campus.
At Harvard, right.
Exactly.
Yeah.
And so because of going into investment banking and the relationships that I was able to create there, and the training that investment banking provides, and then kind of the launch pad to be able to access jobs from there, I ultimately determined that I was on the trajectory and had the network that I was looking for to be able to just continue on in my career versus going back to school for the MBA. But certainly I know many friends and colleagues in the industry who have had a tremendous experience. So I don't think there's necessarily a right or wrong answer. It just depends if you're looking to course correct and get access to a different set of job opportunities. MBAs are fantastic for that. But if you're, already at a place you want to be and think there's enough opportunities where you are, then, that's really how I felt and how I continued on.
The three of you went to very prestigious schools, undergrad. So how important was that? And, you're both the three of you are in positions where you're hiring people as well. And what difference does it make in this day and age if you go to a prestigious university or college or not? Sarah, do you want to start? Because you are running a firm, it's employee owned. I mean, how important is that Ivy League degree? What do you look at?
Well, I'll give you a story. One of the fastest rising partners at Causeway, because we've got 30 individuals own our firm, and we started with many fewer. And over time, as the talent has risen, we've awarded more equity to those people. And we have a couple of superstars who came in and just after, I'd say, a learning period, just went up sharply in terms of career progression. And one of them is a colleague named Fu Sheng. He's now running our China business, but he got his undergraduate degree in China in like pharmacology, and then he went on to get his MD in China, and then he came to the US, and he contacted one of our colleagues and said, "I'd like to be a healthcare equity analyst." And he was almost unintelligible anyway. Like, you got kidding me? Go get your MBA. We should have. That was how we deferred him, and he did. But he went to Duke at the Fuqua School, and we're like, we hadn't hired anybody from Duke before, but nothing wrong with it, and we just hadn't had anybody apply. And he sort of reminded us it doesn't really matter where you go as long as you're really good. I think he graduated at the top of his class. He's incredibly intelligent, and his being bilingual, he's able to do for us what so few can. But his medical knowledge made him an excellent equity analyst. He did a lot of self-teaching, and I think that sort of would be my advice. I'm not sure it really does matter where you go to school, as long as you make the most of it. And it's very impressive for an employer to interview somebody who's outstanding. So he or she went wherever they went and they did really well. Like that, just showing that aptitude and that drive in college or university is impressive.
You know, Karen, I want to ask you, because I too went to a women's and all women's college. It made a huge difference in my self-confidence, I think, quite honestly. But, you know, how much does it matter at Capital Group, for instance, or when you're looking at candidates of, you know, where they went undergrad, or, you know, is it how much difference?
So I would say today it's that, you know, going to the right school is not as important. It's not something that we focus on as much. In fact, we're actually looking beyond the target schools that we used to go to. And as a mother of kids who are applying to college in the next few years too, I mean, it is like really difficult now. It's random too, in terms of what school kids get into. At the end of the day, I think if you're smart, you're going to be smart regardless of where you are. If you're going to be a good investor, you're going to be a good investor. So I think, you know, and to be a great investor, you know, there might be a couple of things that might be different, but at the same time, everyone on this call is smart enough to be an investor. But to be the great investor, there are other attributes that I think are probably necessary to have. And that's being creative. I would say being creative, thinking outside the box. I think that has really helped me with my investment decisions, being able to have a different view from the market and holding steady to that, even though when it feels really bad for a very long time. So there are different things that I think can make you an outstanding investor over time. But at the same time, I think there are, you know, plenty of people here on this call today that can become an investor regardless of what school they went to.
Robin, same question to you.
So, you know, I do think when I entered the workforce, it was of greater importance in terms of opening doors where you went to school. Today, I think there's a much broader perspective in terms of accessing talent. In particular, there's a tremendous emphasis within finance of accessing diverse talent. And there's a lot of discussion industry-wide about you know, being able to go through different channels and create those relationships in different ways for hiring. So I think it's, you know, it's a fantastic time to be, you know, a woman in the industry and looking for that next job. And, you know, you don't necessarily need to have the perfect traditional background to get a foot in the door.
So that is a question that I want to ask each of you as well, is what difference has it made being a woman to your career success or to your career period? Robin, do you want to start with that?
Sure. So, you know, the commercial real estate industry is an extremely male-dominated industry, and because it's within the private markets, I think the barriers to entry for females are they're harder to break down because they're privately owned assets and just all direct intermediaries in terms of how you create relationships. And so it's definitely been an interesting experience being in the commercial real estate industry, and I think it's gotten significantly better over time. But that relationship and networking aspect of real estate in terms of how you secure opportunities and source deals is a real factor that women have to contend with. But I would say that it's worth investing the time and finding your groove to be able to do that within commercial real estate, because it's such a creative industry where you can touch and feel the asset in which you're investing. You can make investments within cities and communities that really change the landscape, or make an investment and bet on the path of growth. And I do think overall the industry is really embracing diversity in a different way now than it has historically.
And do you want to, can you share an anecdote of how did you break through? How did you break into the industry?
Well, I started in investment banking. I was in the financial institutions group covering mortgage REITs. And through that experience, got some exposure to direct real estate investors. And so I specifically looked post-investment banking to join real estate private equity. And being located in LA, Canyon was at the top of my list in terms of firms to join. So I started as an analyst at Canyon. And ultimately, over many years, was promoted and had the opportunity to continue to grow in my role here, which is a little bit unusual to stay at the same firm for such a long time. But I had tremendous mentors every step of the way to help me form the relationships that I needed, and that mentorship element of being able to be successful in the business, I think was really critical to my success.
I mean, male dominated industry, male mentors primarily?
Primarily, yeah.
Mm-hmm. Sarah, what difference has it made being a woman in the industry, to your career success?
I'm convinced it's made a big difference. It is because I look like we all tend to want to find people when we hire them that are kind of like us. It's a human tendency. In fact, we do have a lot of training to keep the men from doing that. That is joke true, out of it,
Sarah. Yeah.
But jokes aside, I think the women that we hire know that we care about women because our CEO is female. And so and our COO, our chief operating officer, who's been with us since inception, is also female. So a lot of that, until we added a few people to our board, we were predominantly a female run organization. And that made it safer and maybe more inviting for other women to join us. So that I know was useful from a talent perspective, and clients appreciate it. And it's so true. They really are looking for diverse managers. We're not really that. Over time, I've diluted my equity stake to get into the hands of younger colleagues, but I can see the need, the just urgent need by clients, particularly big public funds and their pension plans. They want to have managers across the whole spectrum of different races, different genders. They can't have all white males, or there'll be political difficulty for them. And so they've gone out of their way. And I just think that's something that all women should know, that they're really welcome in this industry.
But how did you get there?
Yeah.
When it was a male-dominated industry, and it still is, of course, but when it was really male-dominated,
I'm from another era, but all the doors were closed in my face in investment banking, and I had to force myself to open them.
Like what did you do?
Well, a closed door means you're not wanted in this meeting, but if you don't go in the door, you won't learn anything, and you'll end up doing all the shitty work instead of what you want to do, which is the more advanced work. So it's like my 100-pound hand reach for the door, and I would turn it and then open it, and it was just awful. All eyes, staring. Yes. Well, then all the mentors ended up being men, of course. So, but they were wonderful, and I just had to get more confidence. That was the one thing I lacked. Like I had the curiosity and the intelligence and the drive. I didn't have enough confidence, and it just took years. And that's why, we sort of launched our firm when we did. My business partner and I were just at the point where we'd both, and in my case as a woman, I just had that level of confidence that was just got to the level where I was ready to go off on because it's quite an adventure when you're on your own. They call that cash burn.
Karen, so what difference has being a woman made, do you think, in your career?
I would say it's made a tremendous difference, right? I would say, and it's been good and bad. So I think, the other part for me is that I am Asian, I am Korean American. So when I walk into the room, it's not unusual that I'm the only female and I'm the only minority. So, it's tough too. And I would say, for me, how do I deal with it? It's just really enduring and also finding commonality with people, right? So I did have to read a little bit more about sports to have a conversation about golf or football, because I just felt like that was the interest. I do less of that.
Do your homework. Okay.
I had to do a lot of that in the beginning. And the other thing is it wasn't unusual when people thought I was the person who was I was the analyst and not the senior person in the room. So that happened quite a bit. Hey, can you grab me a cup of coffee? I'm like, not quite. I'll ask someone else to get you your coffee. But now I would say I speak up. I go in a room and I'm literally the only female. And I'll say to the CEO, I said, what's going on here? You got to change this. This is ridiculous. Right. And so I think it's important for a woman to speak up. And I think the confidence issue is real. And there's even a book, The Confidence Code, about it. I want to give this example. I do, my husband's amazing. And I learn from him all the time, but it's pretty incredible when I watch him in his meetings or I watch what he does, because there's no way I would say the things that he does or do the things he would say. He would tell you he's an expert in teaching girls, or what he's an expert in what it means to be a girl because he has 4 girls. He would tell me he's an expert at breastfeeding because he's seen me breastfeed 4 girls. I'm like, it's not quite the same. Right. Whereas I would never say I'm an expert at any of that. So he has really taught me that I need to be much more confident and I need to speak up more. And so what I do now is sometimes when I go into a room or when I have an issue that comes up, I said, what would Sam do? What would my husband do? So I put on that hat and say, what would he do in this situation? And he would not back down. He would speak up. He would ask for every penny that he's worth and more, just FYI. And so so that's what I do to kind of get over my own internal imposter syndrome or fears, et cetera. And I think I would encourage all you women out there to do the same. You guys are all incredible, and you're probably underselling yourselves even in your interviews. So stand out by just being more confident and believe in yourself, because I believe in all of you.
Robin?
Yeah, I agree on the confidence gap issue. It took a very long time for me to be comfortable speaking up in group situations. Similar to what Karen describes, I can't even count the number of meetings where I'm the only female in the room. And I feel, I have historically felt an obligation to know kind of 100% of the facts before I would put myself out there, because it felt too risky to essentially, BS my way through something like a male colleague might do and get away with. I might not be able to get away with that. And so I think, as a result, that kind of overcompensation in some ways helped me advance in the way that I have in the organization, because I just felt an intense pressure to basically be at the top of my game at all times, as one of the only females in the room in many situations. But certainly, over the years, I think that, women, everyone on this particular call can feel confident in asserting themselves much earlier than when they have 100% of the facts. And your male colleagues are doing that all the time.
We used to call it the bluff.
Yeah.
Exactly. Men are much better at bluffing, it seems. Gross generality, but certainly if you've been in a classroom with guys, they seem to raise their hands faster, and even if they don't necessarily know the answer. Biggest success in your career? I mean, what was it? Was there a major turning point, Robin, that you would point to that you could share with us?
You know, so I started within the originations and acquisitions team, so sourcing and closing new deals and being what I would call a deal junkie. I just, love the hunt, love the transaction activity, and the negotiations and twists and turn of any deal to capture a great opportunity. And so that element to me was so exciting and so fun. But at some point, essentially, once you get to a certain point in your career, you stop being the kind of doer and producer of that type of business on an individual basis. And you need to switch to be kind of a leader of people and a manager of people and helping steer toward a common goal. And I think that was a very, very hard transition for me personally. And I'm really proud of my growth in that area, but would encourage, everybody on the phone, once they get an opportunity to manage people, to really push yourself to explore yourself as a manager and the best way to lead. Because ultimately it's, as you continue advancing in your career, it's just, it's a people business.
And Sarah, let me ask you, because I'm just thinking about talking about the career trajectories. What was one of your biggest successes in your career that you feel kind of maybe accelerated your professional status or your own feeling about your self-confidence? What was a big success?
We wouldn't have been able to start Causeway when we did 20 years ago if we hadn't been reasonably successful. And I think when I thought personally, I'd really understood the asset management industry, and I had a pretty good grip on non-US markets because we started off as an international equity manager. It was after I decided that I needed to know what was happening 24 hours in the markets. Now that does sound crazy, but so I did a lot of traveling, and I would sit on trade desks all over the world and talk to these traders and try to understand. I figured they were trying to cheat me, but I just didn't know how. So the more I talked to them, the more I understood sort of how they think about the world. And this was, again, a little bit, we're much more automated today, but it was fascinating to put myself in the shoes of the people I'd be doing business with, and not to mention spending a lot of time with companies based all over the world, and then being able to synthesize all that. It took me really till probably around the year, 2000 or so, just at the time when the TMT bubble was beginning to deflate, that I thought it kind of come together. And it just comes from effort and being curious, and then sort of just having this insatiable desire to learn more. And that's partly what I look for when we interview, is those same sort of characteristics, preferably in a female.
Right. So talk about thinking, outside of the box, Karen, which you mentioned. So, what's been one of your most successful career moments?
So I would say it's probably a little bit over a decade ago, I got invited to be part of an industry group that gives feedback and really gives updates to the CEOs in the industry. And so I thought that was, for me, like a turning point, like, wow, people respect my opinion and actually want to know what I'm thinking, or what my view is on the market, what my view is on their strategy, et cetera. So I thought that was, for me, a turning point. And the other turning point was becoming a full-time portfolio manager. As you said, the numbers are pretty low, 11%, depending on which stats, it's anywhere between 11 to 14% of all portfolio managers are female. That's a pretty low number.
It is.
So really, I'm pushing for more representation there, for more people to raise their hand to become a portfolio manager, because a lot of women just don't raise their hand. They're afraid of the job, or they're afraid of becoming a portfolio manager, but it's really not that much harder. It's just different. So I encourage women to not not be scared to take those risks.
It's interesting because both you and Sarah were analysts at one point. So was the analyst foundation really important to becoming a portfolio manager? Was that kind of an essential foundation?
For me, it was very important because it really helped me build like a foundation and just really setting it up for me on how to think about investing overall. So I thought it was really important for me, but not everyone comes into that portfolio management job with analyst experience. So it really depends on the individuals.
And, switching from successes to the biggest setback. So Karen, what has been the biggest professional setback that you've had, and how did you overcome it?
I would say, the biggest ones are when you don't get the same opportunities that you think you should get as other people. And then that happened over time and over many years, multiple times. So, and that's for me has been, another turning point where I decided to raise my hand, speak up and say, why am I not getting this opportunity? And 9 out of 10 times it was, we don't know, or there was no really good reason. And so I would finally get that opportunity. And it really was because people didn't, I wasn't speaking up as much as I could to show interest in a particular role.
Wait, how important it is. Sarah was saying, 100 pounds opening the door. So is not to be afraid to ask for what you want, or at least to say, look, I'm interested. That's taken some time for you to get to that point.
Yes, right? Because I grew up in an Asian household where you kind of just didn't say much to your elders. You respected them and you thought they made the best decisions all the time. And you just took it. Right. And I realized that's not the case.
So Sarah, biggest career setback for you and how you overcame it, if you did, and what you learned from it?
Well, mine was entirely self-induced. And in order to make that transition from analyst to portfolio manager, that was okay because portfolio managers at Causeway are also analysts, but it's portfolio manager and then being a real CEO, as opposed to, the organization was so small, our COO did all the administrative stuff, but there's so much people management involved in my job. Mm-hmm. And I made some huge errors. I had to actually go and study human psychology. I had to read and think about it and understand what all the biases were that I had, not to mention the people that I was mismanaging, and how to run a meeting, get back to the basics. That I ended up with hiring someone that only one person in my organization really wanted. He happened to be incredibly important, but I kowtowed to one, alienated the rest, and it turned out it was a bad hire. It was a cultural misfit. And I lost the confidence of my colleagues doing that. It took me a while to regain it. And I didn't, it was such an obvious misstep. I still kind of beat myself up today, but it's so important to get some level of consensus and buy-in, get people involved in a decision, get them to take a stake in it, make it their decision. And I had to learn that the hard way.
Yeah. So how did you rectify that? We
fired him.
Yeah. Okay.
We got rid of him, and that was awful. I had to do all that, tried to clean up my own mess, and it was expensive. We had to pay him. And it took me, I would say, a couple of years after that, this was a long time ago, to kind of reestablish my own credibility as a true team member, leader, and manager.
And did you actually, kind of have a confession to your employees? How did you?
Well, the confession was
the employees
termination of them. I've never heard people whoop down the hall like they did when I got, like they heard that guy was leaving.
Robin, so biggest professional setback for you?
Similar to what Sarah just described, I've had to, learn a lot of management lessons real time, and affecting other people's careers and our team. And one of the things that I've really taken away from doing this now for a while is essentially, I came into the manager role, I would say, being more of a kind of conflict avoider from that perspective, in terms of, if you had an issue with a team member, or they were having an issue with a colleague, for example, hoping that it would work out and resolve itself and be okay over time. What I've learned just time and time again is essentially you need to address those things as soon as they happen, hit the conflict head on. Otherwise, you're creating toxicity among the team. So I've had to learn some hard lessons that way as well. And but I think there's no alternative to kind of having some of those experiences play out on your watch as a manager, and then figuring out how to grow from there.
Another question for each of you, and that is, why do each of you think you've been as successful as you have been? I mean, what have you done more than your peers or differently from your peers or your competitors? How do you explain your success? And Sarah, I'll start with you.
If I knew what it was, if there was some sort of formula, I would probably try to multiply it many times over. But keeping great people within an organization requires trusting them and acknowledging them and making sure that they know they're valued. And of course, I screwed that up initially too, but I finally figured that out. And when it really mattered, and I mentioned earlier having 29 other partners, these people know they're valued. They may not have a large stake, but they see others who are perhaps a few years ahead of them, who have larger stakes in the organization, and they see it's a real meritocracy, that individuals are rewarded based on the contributions they make, and there's no politics, no favoritism. That to me is absolutely critical, and I think that's in part what makes the culture so strong and so collaborative.
And what kinds of contributions? Because, when I think of a money management firm, I'm thinking great investment idea, or, that you outperform your benchmark or whatever. But is it more than that? I mean, what kind of contributions are you talking about in your
depends
culture?
On the role. I mean, for investment staff, and it depends again if you're an analyst, and if we have a 2 to 4 year program, and then some get promoted to senior analyst and others move on and do something else or go to graduate school. And then for senior analysts, there's an actual formula. They demanded it, so we let them have it. So they know in terms of weightings, idea generation, and then the accuracy of their models and their collaborative effort and so on. I'm not giving you exactly the sort of secret sauce, but in each one of those things is weighted, and it helps them understand for their bonus what it's going to look like. Obviously, they'll be part of however the firm is doing as well. And then for portfolio managers, it's based on their performance, rolling 3-year performance attribution of the stocks that they cover. And so they're next on the block all the time. They make the final decision on a buy or sell. It can only be overridden by the other most senior person, the president of Causeway or me. And we do it very infrequently because it's demotivating. So people know it's really clear what it is they're measured on. And then there's the additional part. I can't even describe this. Of course, everybody needs to get involved with clients. Even, our traders meet clients. Everybody meets clients, and they used to come to the office pre-COVID, and, that was kind of an exciting thing to show them around. But we need a level of collaboration and mentoring and people involved in recruiting. There's just a myriad of different roles that everybody, or you call it different hats, people have to wear in order to be a true contributor to the overall organization. And we measure all of that.
Yeah. And Karen, how do you explain your success, and what do you see yourself doing differently or more of maybe than your peers or competitors do?
So I would say, as an investor, there are a couple of things that I think that I really focused on over the years, and that's relationships. And that's that's having really long-term relationships with management teams, having actually really long relationships with people who end up being CEOs, CFOs of companies, right? And so really understanding how they think, that there's a bit of psychology in that too. And I have long-term relationships with regulators that I still keep in contact with. So it's having these long-term relationships that I think have been really beneficial. The other part of it is really understanding what information is important. Some people think that having a lot of information and knowing a lot of information is key to being a good investor. But I think it's really about figuring out what the right information is, and how the market is going to react to it is more important than just the volume of information that you should know. So I think those are kind of where I think I have some key strengths versus my competitors.
And Robin, same question to you. What do you see yourself, or have you seen yourself doing differently than peers or competitors, or how do you explain your professional success?
Sure. I guess, beyond a lot of really talented people that I work with, I think I've just consistently had a very high sense of urgency across the board consistently over many, many years. And so just being known as someone who will get things done and do it well, and basically take everything very seriously and with, a high degree of quality, building that reputation over time and being someone that people can count on ends up being really meaningful.
And go ahead,
We
Angela.
need to wrap up in another minute. We've got a record number of questions going here.
Oh, great. Terrific. Yeah. So why don't I'm just going to ask one last question, and then let's go to the questions from the audience. That's terrific, Angela. So this is my question to each of you. If you could only give one piece of career advice to our audience, what would it be? So do you want to start, Sarah?
Oh dear. Well, I want to pack a lot into the one piece, which is, and we've said some of this already, but be confident. Read everything, get your hands on, because to be great in equities, you have to be knowledgeable, sort of in an omniscient way. Like you have to read everything, know everything. You can't. There aren't enough hours in the day, and then being just insatiably curious, because that helps you in the desire to learn more. This is a very competitive industry, and those who are more driven and are able to, and this is why, and it's also becoming a very technology focused industry, because a lot of what we need to do is absorb data that is not typical, we call alternative data, and then make something of it. But those people who are really focused on that and then find that satisfying are going to thrive.
Karen, what's the one piece of career advice? If you could only give one to our audience, what would it be?
Don't limit yourself, because women tend to limit themselves, and they don't realize, a lot of times there will be moments where you want to step back from your career, but I would say just lean into it and don't. I mean, you could be more successful than your husband, your spouse, your partner, and what I see most of is women leaving at the height of their career and then wanting to come back later, but it's hard to get back to the same place. And your husband may not be as successful as you. And so why limit yourself?
Robin.
I would say to make sure that you're in a role where you can see a high volume of transaction activity or opportunities, so that you can just be learning as wide of a funnel of information as possible. As you progress in your career, you may need to be more targeted, be more narrow. But early on in your career, the best thing that you can do to position yourself for success, I think, is to just eat from a fire hose or drink from a fire hose. And so make sure you're in a seat that enables you to do that.
Super advice. All right, Laurie, you've been fielding a ton of questions, so shoot.
Thank you. Well, first, thank you. Thank you to this terrific discussion. It's been really insightful, and it sparked a lot of questions from our audience. So just to pick a few people have asked about ESG. So we know that Tesla was dropped from the ESG index today or yesterday. And there's a lot of discussion around ESG kind of measurement and metrics and just ESG as a whole. What do you think? What do each of you think about ESG? Is it here to stay? Is it a bubble? How do you think about where this is going to head and how it's going to be impacting investors' decision-making process over the long term across different asset classes? And
can I suggest Sarah start with this, because I know Causeway is doing major work in ESG.
Yes, well, I'll keep it brief. You can go to our website and read some of the work we've done. But to me, none of this is new. Environmental, social, governance have been criteria we've looked for in companies from the beginning of time. It's just that now there's a nomenclature, and there's data to measure and there's data to test on. And so what we've done is determined which of these and how to weight criteria within them can help us create performance that's better than client benchmarks. So I believe it's here to stay. And I think the data will become more transparent, more comparable between companies and between countries. And we'll find it quite useful as part, not all, of our analyst toolkit.
Yeah, and I could jump in right after that. I would say exactly what Sarah said. It was the way how we invested as anyways. I mean, you have to be considering all of these issues as part of your investment ideas and as part of your investment thesis. And Capital Group, we are embracing ESG. We've been hiring like crazy in that area. So, we don't see it as a fad. And we've actually taken a very long-term thoughtful approach in how we think about ESG investing.
And no different within real estate. I think it's here to stay. And, the built environment is a big component of the carbon footprint that, comprises the E of the ESG. So it's a big topic within the commercial real estate industry in terms of how to reduce the carbon footprint of the built environment. You've seen for office in particular, a lot of large tenants come out with net zero pledges. And so you'll see a lot of major companies only look to lease in office buildings that can meet their climate targets and be an environmentally friendly space, which goes to what we were talking about earlier in the panel in terms of the flight to quality to newer buildings that can meet those types of demand within certain asset classes. But real estate in particular is uniquely positioned to be able to address these issues, with affordable housing, environmentally friendly assets, and from a governance perspective, who you're partnering with, how you monitor your investments, who you work with from as a lender, for example. All of those things come into play within real estate.
Thank you. And Robin, if we could just ask for your time a little bit more. So there's a question around sort of, do you see lags between what happens in the public markets and how that then starts to trickle into the commercial real estate market? And if so, how do you see things evolving, kind of how the effects of public markets that we're seeing today, how will they show up and when will they show up in commercial real estate?
Yes. So REITs in the public market since their peak have dropped about 20%. And obviously the public markets are able to mark to market immediately, and private markets, real estate doesn't transact in that way. So in the private markets, that price discovery has not played out yet. And typically what you've seen is that at least for real estate valuations, the public REIT kind of stock price movements can overshoot what ends up happening within the private real estate markets. So taking multifamily, for example, before this volatility, the REIT pricing would have resulted in basically valuations of a 3.8 cap for multifamily. Now with the price adjustment, that translates more to a 4.8 cap. I don't think that you're going to see apartments essentially have 100 basis point widening from a cap rate perspective. And so it's probably widening somewhere in the middle. And what we're seeing so far on the ground within multifamily, just as an example, again, is more in the 25 to 50 basis point range. So it just is going to take time to play out. But I think if I had to predict, I think the public markets end up overshooting what the private markets do.
And so a question for all three of you, can you kind of walk us through what a day in the life of a portfolio manager looks like? Who might want to start?
Well, I'll start and just say it depends what their stocks are doing. I mean, if they're falling, their day is bad because they know they have their investment thesis is being tested. And I'm kidding a little bit. It's it's typically, again, like at our firm, analyst work. You're working alongside your group of analysts, understanding better the company. Think about doing a 360-degree view of the company itself, its own competitive positioning, its suppliers, its customers, its competitors, and then getting a much better idea how it all functions together and what the sensitivities are and what really makes that business tick. So that's a lot of it. And then I'm going through the elaborate valuation models done by analysts to make sure they're accurate and that the assumptions applied in them are reasonable, and then being able to convince others when there's a stock action needs to be taken, either a buy or sell, that this is something that's good for clients and makes sense in the context of the portfolio.
I would say that no day is the same. Every day is a different day. One day you could be traveling to go see Tesla, to drive their cars, to see how they're doing. And another day you could be in meetings, just having a powwow with all the different portfolio managers and analysts globally and trying to figure out which asset class we should be investing in, what looks like the best value now. So every day is a pretty different day. We do talk about markets almost every day, but we implemented quiet days too now, because we want to give people time to think and just to like sit back and say, hey, how should we be thinking about this, and giving people quiet time too, and that has been tremendous in terms of just letting us be a little bit more creative, and not jamming us with meetings all the time. So every day is a different day, I would say. But it is very dynamic, and everything could change tomorrow. So just be prepared.
Sure, and I would add, certainly within the real estate investment world, not only are you, reviewing analysis and investment memos and working with your team to figure out the right transactions to pursue, but in addition, there's a lot of travel for property tours and market tours, and meeting with brokers and sponsors and lenders to understand in a firsthand way, through talking with relationships, what's happening on the ground in different submarkets across the country.
Thank you. So all of you mentioned, and we know this is true, that relationships matter a lot, right? As you're building your career, specifically for really everyone, having effective mentors really makes a difference in the career trajectory that we all take. So do you have any advice that you could share for people starting out? So, what has your experience been like? And do you have any advice for how to build effective relationships? We kind of want to stay away from the term networking, because you don't want it to be transactional, but how do you actually build a community around you, both sort of above you and below you, that can help you move forward in the way that you'd like? What's your advice on how to go about that? And maybe specifically for women, and sort of the additional challenges that may come with that. It is hard to build relationships when you're in a male-dominated field and you're the only woman, and things might even get misconstrued, right? You're not sort of able to access the same social opportunities. What have you found to help you overcome that, and what advice can you give?
I'm happy to jump in again. I mean, just because I have no fear. Go with affinity groups. Start with the, high school classmates. If there are any that are in finance, it might be useful to you. And again, you could call it community or networking, but ultimately just a relationship you're forming, and it's a level of trust between you and the other person. As long as you've got something to offer, information or just friendship. And then there's your college classmates and people you've met there. And if you go to grad school, again, I mentioned that earlier, a whole nother group of individuals who could be influential or informative or somehow, and they'll introduce you to other people. But I always advise those that are in the process, I like the term networking, but I'll say community building. When you go out and have coffee with a person who's doing something interesting you think you might learn from, before you leave, get at least 2 or 3 other recommendations or introductions from that individual. Don't just let it be one, make it multiply, so that all of a sudden you've got 3 more people to have coffee with. And I am just remind yourself, you have to work a little harder, but it's worth it.
Yeah. And I would build internal relationships within your firm and external, right? And so I think what I've been really good at is building external relationships. I've got that down pat, but I'm not as good as building internal relationships for me, because I always feel like I need to have an authentic relationship with everyone. So it is a little bit harder for me to build internal relationships. And so that is something I have to continue to work on, but it's really finding commonality with people. And also it not being a one-way relationship, as Sarah said. It really has to be a two-way relationship for it to really last and endure and make a difference and have an impact in your career. Because when it is just one way, it's tough to maintain a relationship that way. But just ask someone for coffee, ask a small group. Actually, last week I asked some younger folks to go for coffee, and they said, "No, none of us drink coffee." So we went to get juice. So figure out what the other person's interests are, and try to reach them there and bridge the gap there.
Yeah, and I would say there's, nothing better for building a relationship than being in the trenches on a project together, or a deal closing together, or, some type of shared goal that you're each contributing to. And that can be with internal people or external folks that you're working on a transaction with. So, every single thing that you're executing on is an opportunity to basically show that you're driven, show that you're curious about the other person, show that you can be valuable, and form a connection.
Any suggestions for candidates as they're starting out to stand out and sort of distinguish themselves from the other pool of applicants? What does that look like?
I love it when people can show their creative side. If there's like some music that they compose, or something that they did that was different, that's out of the, like, then I think, oh my gosh, this person could be really good at the job, versus someone who did, studied business, finance, knows their is great at accounting. Like, I feel like that's the basics. So I always like to see someone who's a little bit different, who could think a little differently, and who could bring a different perspective. So I think it's really bringing your personality and bringing like a different perspective, or something that's a little bit different from everyone else.
Mm-hmm.
Can I follow up on that? How do you do that? And do you have, do either any of you have an example of a candidate that stood out in the application process or something, and that, how did they bring your attention to them?
I always ask them what they do outside of work. And that brings on like a different conversation, because I met this guy, and I didn't know he like, meeting him, I never had the impression that he was like a vociferous reader, and he knew everything about every book out there. And it was just kind of cool to connect with him in that way. We shared some and share some interests, but just like, and he looks at things very differently. So I thought that was just asking them outside, something that's like not a normal traditional interview question.
I just wanted to add something, because it just occurred to me. Well, Karen was speaking that, that something different. Sometimes it's hard to even put it into words, because you sort of know it when you see it. But what really stands out, if it's a research role, that person had better done research on the employer. Like, I'm always horrified when people don't really know what's on our website, or they haven't really read all our papers, they haven't looked at our bios, and they come in and try to wing it. Just something inside of me just dies. So, like, the more, if it's a research job, do research on the employer, research everything, get everything you get off the internet, talk to people, come in with some insight into the organization in which you're applying that other candidates wouldn't have, because you researched it harder and with more effort.
I guess, my thoughts are more pretty basic in terms of what comes across in an interview, which is, if you're confident and enthusiastic about the opportunity, and can also demonstrate, a high level of understanding for the work that you've accomplished in your prior roles, that is a meaningful differentiator. I mean, there are a lot of candidates that you interview over your career when you're looking for a new hire, that they just don't stand out, because the enthusiasm they're bringing to the interview, it's not there. They're, kind of command of what they have on their resume just isn't quite there when you dig a little bit deeper. They're not able to show up with the details to back up that bullet on their resume. So, I think just being able to be, go deep and on any question you're asked about what you're putting on there, and also just be really excited about the opportunity. It goes a long way.
One last question from me and the audience, and I'll turn it back over to Consuelo. So you also all mentioned confidence. How do you suggest, what advice can you give for how to develop more confidence, both in terms of as an investment professional, as well as how you engage with your team in meetings as sort of a broader professional? Any tips on how to gain more confidence throughout your career?
I'll jump in here. I early on had just tremendous anxiety about presenting. Public speaking was a huge mental block for me. Just over time, doing it over and over and over and over again. And just, every time there was an opportunity to present, never backing down, always doing it. And eventually, you find your own style and way to do it that works for you, that is confident. We also at Canyon from time to time actually have had public speaking coaches come in when there were, really important kind of large scale presentations that different people across the firm had to do. And I actually found that invaluable. So if you ever have the opportunity to work with a coach formally, there's a lot of kind of pointers and things that you might not think that you're doing, that when someone else is watching you comes across pretty clearly.
And I said it before, I emulate what I think, the trick that I do is, what would my husband say? What would Sam say in this situation? That really makes me think, oh, I can do this or say this. So that's been really helpful. But I agree with Robin. I mean, public speaking for me, was just a nightmare. I mean, my heart would just pound, and it still pounds out of my chest all the time when I do public speaking. But it is something that you get more comfortable with over time. So practice, practice, practice. The other thing is what I've done over my career is find an ally, someone who could, what I would call, amplify your voice. Because at times when you speak up, in particular, if you're with a room of 20 guys, 30 guys, people actually speak over you. And so what I found, I would actually, it would be the culprit that I would go to and say, hey, the next time I say something, could you repeat what I say and amplify what I said? And I would tell them, I feel like everyone just talks over me. And they're like, oh, no one ever talks over you. I'm like, yeah, I feel like that. And so actually these little tricks that you can do to actually help you build confidence, knowing that you have an ally that whenever you speak, they'll speak up behind you to make sure that your voice is heard. So that's something that I've employed over time too.
And I'll just add to that, those are really well put. Confidence is earned. So the more successes you have, the more confident you become, inevitably. And so get out there and succeed.
So Laurie, do you want me to take it from here? I've got a couple more questions.
Please do.
Those were fantastic questions from the audience, and also wonderful answers from our panelists, of course. I'm going to take you three back to the beginning. And that is, did you have any idea when you graduated from college or Tuck, in Sarah's case, that you would be where you are today? Did you have any idea that you would end up doing what you are today? Sarah?
I had no idea. I went into investment banking and I thought, wow, this is a one-way trip to hell. Then I left to start a database business. I thought, this is good. This is a great business. Just turned out to be much more challenging and required much more seed capital than I had. So I kind of fell into asset management, but a great career fit, you just know it when you're there. And I encourage my own kids to just keep looking until you find it. Don't settle.
That is so encouraging, actually, for the multiple jobs and careers we probably all will have. Karen, did you have any idea when you graduated?
Absolutely not. And my kids still don't understand what I do.
That's okay. And Robin, did you have any idea you would be where you are today?
No, I thought I was going into the business side of entertainment. I had gotten into theater production during college and just loved being on the business side of theater. And so I took an investment banking job in Los Angeles, thinking that that would ultimately lead me to connections within the entertainment industry, and just fell in love with real estate instead.
So what motivates you professionally now, Sarah? I'll start with you. What motivates you the most professionally now?
It's satisfying clients. It's our guide star, and it's been a really tough environment for value managers until recently. And I like building product. I'm kind of a builder, so I like building something that clients want. And we've launched some new strategies in ESG, and that's really satisfying when we create something that clients want and it delivers what they need, which is a certain performance pattern. And that's what makes me the happiest.
Karen, what is motivating you the most professionally?
Well, I think it's two things. It's just being an investor. You want to always be a successful investor for your clients. I agree with what Sarah says. The other thing for me is showing up and representing, right? Because it's in particular, I feel like I want to make sure that the next generation sees more women and they see more people like all of us here today. So they know that there's opportunities for them that exist in finance and on Wall Street, and you can become a portfolio manager at any of these firms.
Robin, what motivates you most professionally?
I love the creativity that you're able to have within real estate investments, and it's not just investing behind a computer. You're able to get out and be in communities and actually invest in bricks and mortar on different street corners and change landscapes. And so it's really exciting to watch our investments over time and watch cities grow and change, and that's really, really fun.
Next question to each of you. What haven't you accomplished yet? What are your remaining goals? Sarah?
Oh, so much. And I'm running out of time. My God, there's so much to do. I get out of bed every
You mean you're
morning,
getting older?
Yeah, there's so much to do. But I really want I want a business that will go on in perpetuity long after I've retired and I'm doing whatever I'm doing then. And that requires building something that is just impervious to whatever the markets can throw at it. I talked about diversifying one's portfolio. I want to diversify the firm so that we don't necessarily have to leave equities, but there are ways of having investments that aren't quite so market sensitive, and perhaps they zig when the others zag. And that would be a kind of final goal, is to create a firm that even when I'm in my rocking chair, it's still there and it's still thriving.
Karen, what haven't you accomplished yet professionally? What's your goal?
Well, I mean, professionally, I don't know if I have a goal. I don't think for me, it's continuing to do what I do as long as I enjoy it. But I also want to continue to make sure that we have better representation, more diversity at every level in our firm. And I think that's really important for me, that when I leave Capital Group, that it looks quite different than when I started.
And Robin, same question to you.
I think, most recently on my mind is kind of furthering how to, I don't know if you can perfect it, but how to perfect this more hybrid and remote work environment that we find ourselves in, and really solidifying a culture and team environment in that hybrid environment that we're all now in. And we've certainly, LA, where I'm based, had a very long remote period. So we're all kind of continuing to find our groove in this hybrid world. But I think there's a lot of positives that have come from it. But still need to kind of evolve how the team atmosphere works, in my view, in this new world.
And Angela and Laurie, I think we're wrapping up here. I'm going to turn it back to you, but I've just been so inspired by these three remarkable women, and also how infectious their enthusiasm is, and the fantastic opportunities that they clearly represent in what they're doing professionally. It's very exciting.
This was one of our best events, and Karen summarized it well, what the pink wall is all about. She can be what she can see, and your panelists were fantastic. Consuelo said your enthusiasm infectious, and Lori, your UCLA, the Fink Center has been such a wonderful partner to us, and Lori was also the one that recruited UC Berkeley, who for the first time joined us in this partnership. The Consortium of Data Analytics and Risk, that's our partner here. We hope to extend this to other schools. That is our goal. So anyone with an idea for that, please let us know. I want to thank also our community sponsors, Peyton and Regal, the Canyon Group, and Benefit Financial Services Group. And of course, thanks to all of our UCLA technicians, our WEALTHTRACK, by the way, this takes a village. There probably 20 volunteers on this that are working. Our own Casey Buhari, who is our CMO at WISE, who does a lot of work, and Lori's team. I could go on, but this was definitely a team effort. And we thank everyone enormously. And just so everyone knows, part of this is going to go on WealthTrack eventually. It will be on the WISE website, on the UCLA website, on the UC Berkeley website. So this is not the end. You will be absolutely memorialized. So thank you all. And a special thanks, of course, to Consuelo, because she's a moderator without peer.
Thank you, Angela, to you too, and WISE, which is just an incredible organization. So onward.
Onward is right. Till the next time.